Most traders treat expiration dates like a secondary scheduling task, picking a number almost at random based on when they hope a stock will move. Days to expiration, or DTE, functions as the primary variable in an option structure, dictating the exact behavioral physics of the contract you are holding. In the options market, every position represents a direct trade on time. This scale illustrates two opposing forces. On one side is theta, time decay, an income stream flowing to sellers, but a daily rent expense leaking from buyers. On the opposite side sits gamma, price acceleration, measuring how violently an option reacts as the underlying stock moves. For the buyer, gamma acts as an explosive ally, multiplying gains rapidly as the stock moves. For the seller, it represents structural risk, the force that can blow out a carefully planned position in a matter of hours. You cannot isolate these forces. To acquire high gamma, you must accept severe theta risk. To collect high theta, you must expose yourself to severe gamma risk. Choosing a DTE is never a guess. It is your exact declaration of how much daily time decay you are willing to pay or collect, measured against the price acceleration you are willing to endure. This coordinate plane maps time against velocity. If we look at the far end of the timeline, we find the 45 DTE window, an area widely recommended by traditional educators. In this zone, theta and gamma curves are low and flat, creating an environment of structural stability. For an option buyer, 45 DTE means purchasing a long runway. You have time for your thesis to play out without immediate destruction from time decay. The cost is high upfront capital. With sluggish gamma, the option is slow to accelerate even if the stock moves favorably. For sellers, 45 DTE creates a wide defensive moat. Higher premiums allow you to sell strikes far from the current stock price. The low gamma risk here means a sudden 1% drop in the market will not cause panic or immediately threaten the position. But that safety demands patience. You are forced to tie up margin for weeks, enduring slow capital velocity while you wait for time decay to erode the option's value. 45 DTE offers maximum safety and runway, but its slow mathematical decay starves traders of capital efficiency and portfolio velocity. When we pan the chart rapids to the right, we enter the aggressive end of the curve, the 10 DTE window. Inside of 2 weeks, the predictable physics of the 45-day window shift into a violent exponential curve. For buyers, these contracts are cheap lottery tickets. They offer explosive gamma that can multiply gains if the underlying stock rips in your direction immediately. But theta is brutal. If the stock stalls for even 48 hours, time decay crushes the contract's value before your idea works. Option sellers operate here to capture maximum theta velocity, burning premium quickly. But they sit on a structural landmine. Inside 10 days, an option completely loses its shock-absorbing capacity. A sudden 1% adverse move in the stock can expand the option's value against the seller by over 300%, almost instantly. Trading inside 10 DTE delivers speed, but it introduces an exponential, unmanageable tail risk that routinely destroys systematic trading edges. Let's view the full timeline from 45 to 0. If long duration is too slow and expensive, and short duration is a volatile minefield, where do we find a structural balance? The quantitative sweet spot for consistency lies in the 14 to 21 DTE window, centering around 17 to 19 days. Zooming in, option sellers capture the steepest initial downward slope of the theta curve without stepping off the gamma cliff. For buyers, this window is capital efficient, providing leverage and 2 full weeks for a directional catalyst to fire. Regardless of strategy, this window requires a strict rule, the extraction ramp. A warning zone highlights the final 5 days, drawing an exit trajectory. The extraction ramp requires you to execute a mechanical profit target, taking the trade completely off the table before entering the final week of expiration. Holding any option into the final 5 days is where systematic discipline breaks down entirely, due to terminal gamma and theta distortion. The 14 to 21 DTE window functions as a mathematically derived extraction zone, maximizing theta efficiency while retaining a physical distance from gamma destruction. Translating this mathematical sweet spot into reliable returns requires shifting our focus from single trades to managing an entire portfolio of positions over time. This dashboard represents the reality for most traders. They mix durations randomly, buying a 40 DTE call on Monday, selling a 7 DTE put spread on Wednesday, and opening a 14 DTE straddle on Friday. Mixing these durations turns a portfolio into an unreadable mess of conflicting Greeks, making aggregate risk impossible to measure. The solution is standardizing your DTE selection. This turns discretionary guessing into an orderly assembly line. Standardization provides predictable pacing. You can deploy capital on a structured schedule, staggering entries so your overall risk is never concentrated on a single expiration date. It also enables mechanical order management. Because every position begins with the exact same time horizon, your exit rules behave with mathematical consistency. You gain clearer expectancy. You stop fighting the clock because you know exactly how fast time will decay and precisely how much price shock your contract can absorb. Time is the one immutable variable in the market. By controlling the DTE dial and standardizing your horizon, you eliminate guesswork and build a mathematically consistent engine for returns.